All right, let's just dive right into this explainer. Today, we're tackling a topic that literally keeps business owners tossing and turning at 3 a.m., demystifying the pretty complex Canadian accounting and CRA tax rules around buying expensive operational equipment. I mean, whether you're outfitting a brand new medical clinic, upgrading a fleet of farm vehicles, or scaling up a tech startup, how you actually acquire your assets matters immensely. So, buy or lease. It's the classic dilemma, right? Every Canadian business owner, startup founder, or farmer looking to scale up faces this exact same crossroad. You absolutely need the gear to grow, but man, that sticker shock can be incredibly daunting. Do you completely drain your cash reserves to own it outright, or do you sign on the dotted line for a leasing agreement? Well, here's the reality. How you choose to pay for that equipment doesn't just ding your bank balance today. It directly impacts your CRA tax obligations and your long-term cash flow. A simple choice on a financing document right now is going to echo through your financial statements, your debt-to-equity ratios, and your tax returns for years to come. It's a huge deal. So, here is our roadmap for today. 1. The equipment dilemma. 2. Buying versus leasing. 3. Two types of leases. 4. Navigating CRA tax rules. And 5. Making the right choice. Okay, starting off with Section 1, the equipment dilemma. Let's look at the foundational problem here. Acquiring expensive equipment requires some really strategic financial navigation. You simply can't just look at the price tag. You've got to look at the invisible financial ripples that purchase creates. So to keep things simple and avoid any overwhelm during this explainer, we're going to consistently evaluate every option using exactly these 3 crucial pillars. First up, cash flow. How much working capital does this tie up today? Second, tax deductibility. How quickly can you actually write this off against your taxable income? And third, balance sheet impact. Is this equipment going to show up as a liability that might skew your debt-to-equity ratio and mess with your future borrowing? Moving right along to Section 2, buying versus leasing. When you're staring down this traditional binary choice, I want you to think of buying kind of like holding a mortgage on a house. You build equity, sure, but you completely tie up your cash. You own the asset, it's yours to sell, but you take a heavy hit on upfront capital. Leasing, on the other hand, is a lot more like renting an apartment. It offers incredible flexibility and preserves your working capital for daily operations. But at the end of the term, you don't own the asset. You literally just hand the keys back. Now, take a look at this matrix. It brilliantly illustrates the core differences. Looking over at the buying column, the tax treatment relies on the capital cost allowance, or CCA. Basically, this means you can only write off a portion of the equipment's cost annually based on its specific CRA class, say 20% for general machinery or 30% for computers. It's a really slow burn. Leasing, however, can offer immediate, full payment tax relief right in year 1, acting as a fully deductible operating expense. Plus, and this is big, it stays entirely off your balance sheet. Okay, on to Section 3, two types of leases. Now, here is where so many business owners get tripped up. You see, to the CRA, leasing isn't just one single uniform category. It's split into 2 completely distinct tax treatments. The first one is the operating lease. This is essentially just a short-term rental. Because you don't own the equipment at the end of the term, you don't take on the liabilities or the depreciation. The massive benefit here is that your monthly installments are fully deductible as operational costs in the exact same year they're paid. This makes it an absolute game changer for things like medical tech or computers that need frequent upgrading before they become obsolete. Conversely, we have the capital lease, also known as a finance lease. Now, to the CRA, this is treated exactly like an asset purchase. It's much closer to a rent-to-own scenario, where you're assuming all the risks and rewards of ownership. You actually have to record this on your balance sheet as a liability, and you can only deduct the depreciation through the CCA over time, plus whatever the interest is. Usually, this rule kicks in when the lease lasts for 75% or more of the asset's total useful lifespan. So the crucial takeaway here? We absolutely have to bust the widespread myth that all lease payments are just simple, 100% immediate write-offs. They're just not. Only operating leases allow you to deduct the entire leasing fee directly without recording a liability. If you sign a capital lease, well, you're fundamentally buying that equipment in the eyes of the taxman. All right, Section 4, navigating CRA tax rules. Whichever path you end up choosing, staying compliant is absolutely critical. To actually claim those rental installments as tax deductions, your contract must strictly adhere to the CRA's rules. The equipment has to be primarily used for commercial purposes to generate income. The installments must be reasonable for whatever the asset type is, and above all, it must be a legitimate rental agreement, not some disguised purchase. So, Keep your contracts and your payment receipts meticulously documented because, let's be honest, the CRA loves a good paper trail. You also need to do your very best to dodge these red flags. The CRA looks incredibly closely at agreements that include an automatic ownership transfer or a buyout price at the end that is significantly below fair market value, basically a bargain purchase option. Also, if your lease duration covers more than 75% of the machinery's useful life, watch out. If the CRA spots these things, they might just reclassify your nice, fully deductible operating lease into a capital lease. That completely changes your tax standing and forces you to rewrite your balance sheet. Oh, and you definitely need to be aware of the exceptions. If you've got mixed-use equipment, you must prorate it. For example, say you use a truck 70% for farming operations and 30% for running personal errands. Remember, you can only claim 70% of those lease payments as a business deduction. And speaking of vehicles, if you're leasing a passenger vehicle, strict CRA caps apply to luxury cars, which really limits how much you can actually write off. Now here's a truly fascinating little caveat straight from the Canada.ca rules. If you lease qualifying property, think like a massive combine or a commercial fishing boat with a fair market value of over $25,000, you and the lessor can actually agree to treat the payments as combined principal and interest. By filing specific CRA forms, like Form T2145, the CRA will consider that you essentially bought the property with a loan. It's a super unique election you can make, but just keep in mind that everyday things like regular office furniture and cars typically do not qualify for this. And finally, Section 5, Making the Right Choice. We've covered the structures, the math, and the pretty strict compliance rules, so let's synthesize all of this to figure out what strategy actually fits the reality of your business. Let's bust one last myth here. Buying isn't always financially superior just because you get to own the asset at the end. Actually, scratch that. It's really all about timing. It entirely depends on your immediate needs. If your business is thirsty for immediate operational cash flow and you're sitting in a high tax bracket looking for fast savings, an operating lease works absolute wonders. But if you've got capital to spare and want long-term equity, buying spreads that tax relief out beautifully over time. This really puts it into practical perspective. If you're a fast-growing tech startup needing servers or a clinic needing the latest imaging tech that's going to be a dinosaur in 3 years, an operating lease makes complete logical sense. But if you are a farmer investing in a heavy-duty tractor or an excavator meant to last 20 years of hard, grueling labor, buying outright or entering a capital lease is almost certainly your winning move. So, armed with a solid understanding of cash flow impacts, the vital nuances between operating and capital leases, and how this whole shebang lands on your balance sheet, it is time for you to look at your own business trajectory, evaluate your cash flow, and have a sit-down with your accountant about your specific CCA classes. But before you sign your very next equipment contract, I want you to ask yourself this. Is your current financing strategy secretly suffocating your business growth, or is it building the solid foundation for your empire?